I guess for us, the change beneath the surface has been from about a few months ago when the whole world was talking about a recession, talking about potential a short squeeze in markets to rally, but they're fundamentally expecting a slowdown this year. And I think that shifted beneath the surface where you've actually seen almost the opposite start to be considered, where the outlook for the economy, especially in the US, looks quite strong, but positioning is also quite stretched in that direction. So there's likely to be a pullback in the market short term, but more fundamentally solid. I guess one thing that's changed in our view is if you think about the past, say, couple of years since COVID, we've been having what we call rolling recessions. What we mean by that is when you had, I guess, COVID, you're locked in your room, goods did really well, services cratered. Then when you were let out again, services did really well and goods fell off. And the expectation of the market and economists in general was, what type of landing are we going to have? So a soft landing means that effectively you're going to have services catch down to manufacturing, but not so bad that you can actually recover, or hard landing as they both join each other in recession. What we're seeing now is actually a boost to the upside. So rather than catching down to manufacturing, services has ticked up again. So I think the ISM services PMI is at 43.4 now. So that's a pretty strong bounce up from the 50 level. And we're actually seeing some signs that the manufacturing PMI will start to lift off. So if you look at, for example, on this slide here on the right-hand side, you can see manufacturing PMI and then showing as well new orders minus inventories, and that's ticking up again. So it's more like manufacturing is catching up to services as opposed to services catching down. And if you look at the S&P flash PMI for manufacturing, it's a 51.5 now, which is a 17-month high. So we're joking internally, rather than having a crash landing or hard landing or soft landing, we have reacceleration. And it's almost like when you abort a landing on an airplane, you have to sort of reaccelerate back up again to try to land a second time. So for us, we're calling this sort of the go-around of the US economy. It's coming back up again. And that's caused our economics team in London to increase their forecast for US growth from a low of 1.3 for this year up to 2.7. So a big boost upwards. And it's on the left-hand side here. Those dots are the sort of previous forecasts and the bars are the current forecasts. So pretty strong expectations for US growth. So fundamentally, we're quite positive on US growth because we think economic data is going to be improving and the market will catch up to that fact. I guess further afield, Europe looks like they're already in a recession or just avoided a technical one. Links to China, EM's being quite weak, especially because of China. So less positive there. But places like Japan, who are also in a technical recession, but we do like that economy because A, the equity market still looks cheap, and B, the structural reasons for the market to do well. So long story short, turning more positive on the global outlook because of the US. But I guess we can talk about equity valuations and stuff later, but the economic standpoint we think is more positive because of that catch up in both services and manufacturing.